The broadcast is now starting. All attendees are in listen-only mode.
Hello, everybody. Thank you for joining us for today's public webinar. It appears that GoToWebinar was having trouble. One second here. I'm trying to get this. Okay. Yeah, it appears GoToWebinar is having different issues. I don't know if some people are having trouble getting in. Hopefully not. It seems to be somewhat resolving itself, but we weren't sure if it was going to happen because of all the trouble. We couldn't even open the webinar just a little bit ago. So anyhow, knock on wood, things go okay now. Good afternoon, Jim.
Good afternoon. All right. What I start off with is just the basic comment that I make over and over again. Markets hate uncertainty. And the reason that I stress that so much is so many times traders are heavily focused on their indicators, on moving averages, etc. And you can miss the big picture when that's going on. Markets hate uncertainty, and this is what the current administration has introduced into our markets. And if you can't let that frustrate you, in other words, the market's not going to adjust to you. You have to be able to adjust to what the market is doing. With the volatility that we've got in the market, I have adjusted to a strategy that, and many times I have told you, in my opinion, is probably one of the worst strategies you can ever engage in. Yet under these conditions, that is my primary strategy. And what I'm talking about, I will historically say that straddling the market is a terrible strategy because it's very difficult to make up the premiums on both sides. Under the current conditions, that has been paying off very well because the volatility has been extreme in the movements in the market. And that's based on the uncertainty. Markets hate uncertainty. Now, along with that uncertainty, gets to the point where inventory is constantly getting too long and too short. Most of the market's being driven by short-term traders. Short-term traders get very emotional and they just sit there and pile on to each other. For example, we saw the market, break sharply last week, and then we had a short covering rally. Look at this rally, look at the size of this gap. Huge gap. But now look at the shape of this profile. The shape of that profile is that of the letter P. The title of my current book is Markets and Momentum: How Profiling Gives Traders an Advantage. This is a wonderful example of that. So many times, momentum traders are simply looking at price. When you're simply looking at price, it's not giving you any context to what is going on. When I look at this huge short covering rally, and then I look at the profile, I see the P shape. Lots of single prints, but then you get kind of the P formation on top. So what this communicates to me is that I am getting old business or short covering, but that short covering is not being joined by new money buying. If the market was being joined by new money buying, this would elongate out. So you'd have the short covering and then you'd have new money buying. The profile would be elongated. Now, doesn't mean it doesn't stop immediately because, once the momentum traders, once this is getting in there, the momentum indices have have ticked up substantially, and you watch they're saying, okay, the momentum traders are continually buying everything. Now I'm going to split out yesterday. And if you look at yesterday, what were the momentum traders doing? They were buying every break. And what were they getting for it? Nothing. I mean, they bought every break all day long. So the market is getting longer and longer and longer. So now what do we have? That uncertainty kicks in again today with the talk that we're going to get another announcement on the tariffs, at the market close. So the market got longer and longer and longer. First, it was too short. So much of short-term trading revolves around inventory constantly getting too long and too short. The reason for that is because so much of the trading is very short-term emotional traders. So the market got too long yesterday, buying every break. One bought it. And you can just feel what's going on. The momentum traders are looking at their indices. They've all ticked up because of how much the market has rallied, and they're getting longer and longer and longer. That uncertainty sets in again today. And now what are you getting? You're getting a liquidation break. Now, when you come through, remember this huge gap in here. There's no, what's so dangerous when you get back into this area, when the market starts to, go the other way, there's no backing and filling anywhere in order to find a logical place to stop the break. So you're getting first you got the short covering, then the market went from excessively short to excessively long, and now you're getting the liquidation from the longs, and you're getting more shorts in the market. Now, I don't know what this is going to do, what's going to happen in here. And this is also a trend day. Okay, but as you look at this trend day, little tiny pieces, the C and D period match, that's very odd. And look, it's almost right at yesterday's low. That is not the sign of longer term selling. That is more than likely shorter term selling following price. Look at the E period high, halfway back from D period. Another indication that the selling here is by weaker hands, short-term traders. And but it is a trend day because you're one time framing lower all except for the G period. One more time, look at the J and K period match. This is more indication to me is what is happening, that we've gone from too short the other day to too long, and now the market is very likely in the process of getting too short again. And why do I say too short? Because of all the mechanical references. We cover them one more time. Okay? C and D period match, and they're almost at yesterday's low, mechanical. Yeah. E period high, mechanical, halfway back from D period. H period high, almost half back from G period. J and K period match. So more than likely what's going on, short-term traders are selling every rally in here and more than likely getting the inventory too short once again. Now, that doesn't mean that the market's going to rally. But what it does mean is that the odds of a surprise to the upside are very great. Markets hate uncertainty. So now the market's still trying to fill this gap. We've got about 45 minutes to go. But is there any question when I say the markets hate uncertainty, but understand that so much of short-term trading is inventory getting too long, inventory getting too short. Short-term traders constantly get whipsawed back and forth. It's very, very difficult. It's very challenging, and you get caught up by price. Okay, let's take a couple of questions.
Jim, I just wanted to point out, in case folks are confused with how your charts look, you're in 1 tick increments right now, aren't you?
I don't know.
I believe that you are, just in case anybody, because usually, you know, we're in 2 ticks, and I didn't want folks to be confused. No, you're
No, I'm in 2 ticks.
Okay, strange. I thought you were in 1. Okay. Okay. Do you want to take some questions?
Yeah, hold on. I'm trying to get. I'm trying to get this panel out of here. I don't know what. I've got this panel blocking me, and I don't know how to get rid of it.
Oh, no.
Can I just exit out, or will that close it?
That the red X where you're pointing over right now would be okay. Yes, not other X's, because
Okay,
yeah.
okay.
There you go.
Okay. Yes, I'm ready for questions.
Okay. Okay, somebody's asking, on Monday they bought 57.59 at exact references. This was a key nuance you had taught recently to monitor for breakdown of shorts.
I'm sorry, I don't understand. I don't understand the question. I'm sorry. What else we got? I'm sorry. I'm sorry. If you could come back to the
Sorry about
question.
that. I was on mute. I was trying to say, please come back and clarify your question, and then we can circle back to that. Sorry, I was on mute. Another question here. Wasn't the volumes for the last 2 days also cutting off activity to the upside?
It was, but I don't put too much confidence in this with this volatility in the market. It's not like I have a market or we have a market that has a good balance between, you know, day time frame, intermediate time frame, and long-term time frame. Basically, what I'm seeing in here is mostly short-term day time frame traders. And I say that because of the total exactness from which it trades. And so that volume, you know, I think a lot of the bigger monies on the sideline, they're confused. They don't know. Remember, markets hate uncertainty in here. Okay? I mean, I'm sorry, I just don't, I think there's so much uncertainty in here that I'm not doing a lot of relying on volume.
Okay. What are the signs that these short-term sellers, because of exactness is from mechanical references, will be a problem?
It's an overall picture. Let me give you something that's somewhat complex. When you ask a question like that, you're looking for an exacting answer. And exacting answers don't exist. For example, one buy at an exacting reference may be relatively insignificant, or one sell an exacting reference. 2 sells at exacting references take on a little more significance. 3 sells a little bit more. There's no, you know, and how overextended was it? There's no exact answer to that question. What I'm looking for here overall is to say, who am I competing against? And when I see these exact sell references like we're seeing today, that tells me the chances are I'm competing against very short-term traders. When I'm competing against very short-term traders, I know that the possibility of a very wicked directional change for short covering or long liquidation at any moment is possible. Okay, so I'm getting into I'm trying to understand my competitors, who my competitors are. Like I say, when I say these exacting references, more than likely it's not longer term money selling. More than likely it's short-term trading money. And it's the short-term trading money that's not sticky money. They tend to get constantly too long and too short. Now you come down here and you look at the low, today's low. There's no excess on the low. So again, probably short-term buyers covering shorts. And remember, we've got matching highs up here. You're coming in late into the day. The inventory is very, very short. And the question is, do you get a short covering rally going into the close? I don't know, but the possibility certainly exists because inventory is short. Now the world is saying one more time they've got out there, and it's that Trump's going to make some announcement on tariffs at 4 o'clock. What that's going to be, I don't know. I mean, I've heard some of the experts talk and say, well, if it hits Mexico and Canada, it'll have this effect. If it hits, Europe, it'll hit this. I mean, nobody seems to know what it's going to be or what effect it can have on the market. And the market doesn't seem to know. So again, you're in a very, very treacherous territory. And this is another reason why I am using options so much in here. Because at least with options, I know what my risk is. And it's easier for me to hedge the risk, with other options. And incidentally, while I'm using the ES, while I'm looking at the ES here, as we look at this, most of my trading is with the SPY. And as I've said before, one of the reasons I'm trading so many of the SPYs is that the market is so deep and the executions are very, very satisfactory for me. The ES market, I find, is, if you're in the institutional category, you're trading, 100 lots, the market's pretty tight. But if you're like me, you're trading smaller size, 3 to 5 lots, the slippage is considerably greater. I find that the slippage is much less on the ES. That's just a commentary in here. Okay. Okay. What other questions do we have? Now, let me go back and talk about a little more on the strategy. I said that the strategy I normally say is one of the worst strategies possible. Buying spreads, buying straddles and strangles is exactly the strategy that I'm employing today. And what is important, what I'm doing is when one side moves enough that I can sell a higher strike price call or a lower strike price put against it and take myself to worst case, a break-even type of scenario or very close to it. That's what I'm doing in order to take the risk out of it, and then looking for a counter auction that allows me to lift one side. So I'm actually trading against it in there. But I'm not using any specific references other than, I'm not oblivious to what is going on in the market. I'm going to put up a bar chart here. So if you take a look at what, this is the SPY bar chart. I like the SPY bar chart. And, this is what the markets, you can see today. The highs, look at how mechanical the high went. I've been using this reference, this gap low. I've been using that reference for some time, break above and below. And of course, it broke below it. The rally was right back up to it. Now back down. So I'm, again, when I see these constant mechanical references in the market and all of this, adherence to this trend line, that is another indication to me that I am dealing with very short-term traders. And I know that the personalities, very short-term traders, is very emotional, and they tend to constantly take markets from one extreme to the other. That is, as a trader, as a short-term trader, that is very usable information. Okay, what else?
Okay, do you mind somebody asking about the NQ?
I don't have the NQ up, so it's going to be hard for me.
I didn't know if you still have it. If you look at it, I've
got it on another screen.
Yeah, you don't have to bring it here. So they're just going to ask. I'll just ask the question about it. You can answer based off.
Okay, go ahead.
You have it on a different screen. That's okay. Today, the NQ also sold off at exacting references such as overnight half back and yesterday's session low. I did not expect such a liquidation break to the downside and therefore bought the reclaim of the overnight low to go with developing value, but covered that trade quickly. Was there something I overlooked while taking that trade in A period? We had short overnight inventory, which got corrected, and a mechanical sell-off, which ultimately brought me into this developed trade.
No, I think it was, and it looks very similar. It hasn't closed the gap. What you did have in there, you had a long selling tail in the morning, and value clearly building lower. My guess is you were just managing it too tightly. What makes this easier if you're simply looking at mechanical references, which you were, the overnight high and low, I understand, but you're leaving out the bigger picture of what's going on. That can really mess you up as a short-term trader. And I say that because it certainly happened to me more than once. But I'm sitting there and I'm trying to say the perspective, okay, what is going on overnight? Or what is going on overall? I'm looking at the bigger picture. For example, I know, at least I think I know, that the rally was short covering. Okay. And then you had the following day where you had the P formation. So that showed more short covering, but it wasn't joined by new money buying. So that sets up whether that was, and that happened, the same thing happened in the NQ that happened in the ES, happened in the SPY. No real major differences in there. So my bigger perspective, I'm saying, okay, what am I dealing with on a bigger perspective? I'm dealing with a market that's gone from too short to too long. And there's no, when I came with that huge gap, there's no backing and filling in that gap. So the chances are that the market can give any little push at all, the market can give way and start down, because there's no, a strong market will stair step up. It'll go up, move sideways, consolidate. So I don't see any difference in the NQ versus the ES. I think you were micromanaging the trade, which is one of the things that kills us. And I think it's more important to be able to constantly step back, know what the trend is, know what got us to where we are. What got us to the big rally, was it a combination of, short covering and new money buying? That would give you higher odds of continuation. Was it mostly short covering? That would give you lower odds of continuation. So your mindset would be looking more for a downside break in the market. I mean, and that's the kind of thinking, what the bigger picture, and this, sometimes people get all scared off by this. There's two types of thinking. There's explicit thinking and implicit thinking. When you talk about, okay, we know there's a high percentage of chance that you get a counter auction to the overnight inventory. It's probably around the 79%. That's kind of explicit thinking. When you see the highs and lows, it's kind of explicit thinking. When you start to understand that the whole market is probably short-term traders, you're now starting to get more in the realm of implicit thinking. What happens to us? This is a little complicated. Too much focus on explicit thinking. Too much focus on explicit thinking would be too much focus on trend lines, exacting references, and everything else. Can keep you from really being able to exercise the implicit thinking. The implicit thinking, another way to put it, that's your intuitive thinking. That's when you really have some understanding of the market. You understand the flow of the market. It's just a bigger picture. It's not one you can talk about exactly. The intuition, you can't, well, I don't know why I felt that way. You meet somebody, but that's really important. A good trader will have a good balance between explicit and implicit thinking in the market. Okay? I know that can be confusing to people, and sometimes I get irate emails that, people want. If you get irate because you want exacting references and answers, you probably have a problem with trading. It just doesn't work that way. Okay, what else?
Okay. Somebody's asking, since yesterday we closed the regular trading hours near the day's high, but the overnight stayed below it, and overnight inventory would be categorized as short. However, given the M period spike that pushed the close to the highs, I don't think we had a spike yesterday, right, Jim? Did we? Should we still classify overnight inventory as short, or is it more balanced relative to the previous day's cost basis?
I think you're far overcomplicating the situation. It's just the other things are far more important. You're trying to make trading a science. That's you're focusing very heavily on explicit things, and that's where we all start. You figure out exactly, is the overnight inventory long or short, in there. Now, your observation. Now, let's go take an observation that would fall in the implicit category. Your implicit observation, explicit but implicit interpretation, that the overnight trade did not take out the daytime frame market. That is a valid observation. That is a very valid observation. If there were any underlying strength in there, you could have easily taken that out. You didn't. That is an implicit observation. The other, you got to be very careful. Now, you look this morning, you've got single prints. So the market's fairly aggressive, right? You're coming down, you've got single prints. We look below the yesterday's low, get a little rally, and that's all you got. You leave all these single prints. What's happening to value? Value's building lower. We're below that value area, well into the value area from the 24th. And then you've got all of this space underneath, okay? But you got to be, I know what you're doing. And when I say I know what you're doing, it's because I have a very good memory of what the things were I did when I first started trading. And if you remember, if anybody's heard me, I spent over 20 years of being unprofitable. And there's not I learned absolutely nothing the easy way. Absolutely nothing. And I was a very slow learner. I had to learn many things over and over again. My goal is to help you not look at identifying trades, but help you think about the market and how the market operates. Okay? Jen, you want to do a commercial? Jen, are you there?
Yes, I am here. Sorry about that. 1 second. Let me get the screen back. I'm just concerned about GoTo because I'm still having but some behind the issues scenes with it. Can you see my screen?
Yes, I can.
Okay, so for those of you that are new, or if you're still on the fence, we do have a live market profile primer coming up in April. It's going to start on April 23rd and run through May 1st. Currently, the sale price is $519. You can find this by going to our courses at the top navigation of our website and scrolling down and seeing our courses, but you'll see the primer featured up at the top. This is a live 8-day course. So for those of you, you don't have to have market profile charts in order to join us for this course, and you do not have to have any prerequisite requirements to join us for this course, because sometimes we do have prerequisite requirements, but we do not have any for this. And all of the webinars are going to be recorded, and you'll have access to materials to review for 3 months after the course finishes. So in case you live in a time zone for which you can't attend all of the classes live, or for those of you who have a day job and may not be able to attend. But it's great. It's a great course for beginners who are new to market profile. Those of you who are a little bit experienced want to make sure you understand the concepts as Jim teaches them, as well as for any of you who are experienced but are wanting to just get a review, a really good review of the basics. Because as with any professional, you always go back to basics. So if you have any questions about this course, you can feel free to shoot us an email at daltonjim@daltontrading.com or give us a call. I'd be happy to speak with you. And Jim, I don't know if you have anything else you want to add to that. I'll say that the first 4 days of the course, we're taking linear teaching portions from our foundation, our online at your own pace foundation and application of the market profile eCourse, and that's turned into the live course for the first 4 days. And then the latter 4 days is Jim narrating the markets and trying to apply any of those concepts that he sees during that time. And we'll also provide daily reports for those latter 4 days.
The major change between this primer, the ones we've done in the past, is I am working very hard to start to introduce you to how you integrate explicit and implicit information into observing the market. Now, and I understand that's gonna leave some people even more confused because you have to learn the basics first. But too many times what happens, people learn the basics and they want to immediately put those basics to work. And just learning the basics isn't enough. And then they lose money and they get frustrated and then they go to something else or add something else on before long. Remember, the success ratio is extremely small for daytime frame traders. So I'm trying very hard to work in this idea of explicit and implicit information. Let me make that a little simpler. What we're really saying is you can sit in the grandstands and watch a baseball game. You can know all there is about the hitters and about the pitchers and everything else. You can have all the statistics, and you can be, really bright. But you can't stand in the batter's box and hit the ball coming at you at 100 miles an hour or 90 miles an hour. It takes many, many thousands of swings in order to do that. The information you learn in the stands and all the statistics is explicit information. Standing in the box, taking one swing after another until all of a sudden you're starting to get the feel for the game, that's implicit information. You are never going to be a pro ball player. You are never going to be a pro trader without a healthy combination of implicit and explicit information. So what I'm trying to do in this primer is not, you can't fully cover it, but I'm trying to help you start to understand and appreciate that concept and how it works and how much time it takes. Too many people are too impatient in there. Okay, I hope that's adds something, but that's what I'm working diligently on in order to really make this quite different than anything else we've ever done. Okay, what other questions?
And for those of you that are new, you can go to resources, the top navigation of our website, books, and you can see the link to Jim's newest and latest book here to Amazon, as well as our suggested reading list in case you're not familiar with that. Okay, Jim, I'll give you the screen back.
Please.
Okay. There you go.
Okay, and come on with more questions.
Okay, I don't see your screen. Okay, there we go. Okay, somebody's asking, are short-term traders more likely to leave a poor low or no excess on a day like today?
Yes. Yes, and we were at that, yeah, and that's a great question. If you think about it, larger money, whether it be institutional, or hedge funds, they don't buy. I mean, does it occasionally happen? Occasionally there'll be a program that buys exactly, but not very often. who buys at exacting levels? Those are generally weaker hands traders. Bigger institutional money, you don't even quite know where they come in. They go to great extremes to disguise it. If it wasn't disguised, they would front run. So yes, when you see the mechanical references, that is on both on the upper and the lower end, that is usually an indication that it's weaker hands traders. Now, that's just knowing who it is one thing. Then you start to say, okay, understand their actions and understand how volatile their actions can be. When I talked today about, the tremendous number of, we've got a poor low down here with no exits. The number of mechanical references coming down suggests to me that the inventory is once again very short. Now, I don't know what the announcement's going to be at 4 o'clock. But if that announcement, the markets assume that announcement's going to be negative. And everybody's afraid, FOMO, fear of missing out. So everybody's on the short side. When I look at this inventory, maybe they're right, but understand if that message isn't as negative as the world's made it out here, you could get a pretty good short covering rally again. And then I stop and I say, okay, in order to put in perspective, go over here and I go to the bar chart to get perspective of where we are and what this looks like. So it can look like right now they're pretty close to a trend line in there. I'm not a trend line person, but markets do that. And they did it here, they broke it. They did it here, they broke it. And then they rallied it. I mean, it's just, this again is almost, when you go all this from here to here, across here, that's almost all short-term traders. Going on for weeks. That's not how longer term money trades. Almost all short-term traders, and it gets too long, too short, too long, too short. Okay, what else?
Okay, somebody's asking, is there a specific reason why we didn't get new money buying? In the case of if we got new money buying yesterday, how would that have impacted today's trading?
There's no answer to a question like that. I mean, if you got new money, how much was money? How much was it? You don't know that. You're trying to make this a science. Trying to make it a science. If you're looking overall, was there any predominance yesterday of new money buying? The answer is no. Had you had any predominance of new money buying in there yesterday, you're not going to get a market that's truncated like this. So what they're buying the lows, and they're getting nothing. If that was really some strong money, you'd extend to the upside. So again, don't try and make it exacting, because you're never going to, you can't exactly hit a baseball. You have to have a pretty good understanding of, the pitcher. You've watched tapes. This is where I talk about, this is where that implicit knowledge comes in, that you just, over a period of time, all of a sudden, the light bulb goes off. And I'm looking at this yesterday, and I'm just saying, yeah, you kept getting short covering and you kept getting mechanical buying, because the momentum was up. Because all the momentum indices would have kicked up here with the big short covering rally on this day, but there was no follow through, nothing there. Okay, now it's hard because so many times people get addicted to price. They get addicted to price, and it's very hard to get away from that. If you've got that addiction, it's very hard to get away. The other thing that I'm going to say here that really usually gets all kind of people, throwing darts and bricks at me is if you're using 1-minute charts, 5-minute charts, 15-minute charts, I think you're doing yourself a great disservice unless you do that and you're constantly profitable. I use nothing less than a 30-minute bar chart. Anything less than that starts to mask for me what is really going on in the market. And I get people that are just irate when I say that. But remember, I'm doing this going on 50 years. I've seen an awful lot. Okay, what else?
Okay. Would you consider March 17th through 21st as a 5-day balance? If so, we're currently trading at the top range of that balance.
Yeah, again, I go over to the, I go over here, and this was the bigger balance right here. We broke below this. So I had this, and then I had, it was very weak, but over the weekend, I had this as a balance, and I had this as a balance. Not very clean balance. But what you did, you went up here, and now you've re-entered this balance. So the question is, you come in tomorrow, do you show extension? If you show any more extension to the downside of this, remember, if you read my comment over the weekend, I broke this into a 5-day balance, another 5-day balance, and we applied the balance trading guidelines. If it remains within balance, it further tightens the balance. Okay. You look below balance and fail, or you look above balance. Now here you looked above balance and you failed and you came back in. So usually that is not a good sign. You look, what you'd like to see, you look above the balance, you'd like to see above the balance bring in more activity. Instead, you got more activity, but it didn't last. And now you're back within that balance. Okay? There's no, remember, this market, this is a long time, this market. The longer term money, and you hear them, if you listen to the, you listen to them talk on, CNBC, the long term money, so many of them, are complacent. Oh, the market's going to be good, et cetera, et cetera. Well, they want to believe that. I heard one, woman yesterday, very articulate, and I remember my registration at the time. She said, well, the market's going to sit in a holding pattern. It's not going to do anything until after April 2nd, when we have more on tariffs. Well, guess what? It didn't wait for that. And that's why you have to look at you have to read them, learn to read the market. One of the worst things we do is listen. And I tell people, don't listen to the commentators, because they will confuse you. They sometimes will sound very articulate. The example that I've used for so many years, I haven't used it in the last couple of years, but many years ago, I went to a conference, an institutional conference in Boston. And there was a firm by the name of White Weld, which used to be a big institutional firm, or a boutique institutional firm, talking about the Japanese yen going higher. And it was a beautiful, beautiful presentation, and I was absolutely sure they were right. They were followed by Goldman Sachs, which gave an equally great presentation about why the Japanese yen was going lower. I agreed with both of them. I mean, you listen to them, they're articulate, all of that. You've got to learn to read the market yourself, understand if you want power, understand market generated information, understand what is the information you're getting from the market. That is your direct source. And what I'm trying to say in here in the new book, Markets and Momentum, how profiling gives traders an advantage, is so much of the world is momentum oriented. Momentum is simply, it's price-based momentum. There's no real context to it. When you start to marry market generated information, which which are your poor highs, your poor lows, your shapes and things like that, with momentum, now you've got yourself a much more powerful approach and way to look at the market. Okay, what else, Jim?
Okay, are you carrying forward the poor lows from the 18th and 21st?
No. I'm sitting there, I'm looking at today, I'm looking at the, you're a long way. You're
I'm
a long
assuming
way
you're a
down
long
there.
way from it, so it's not in your purview right now. But if we were to go down a lot further and it comes back into
Probably
play,
not.
then you
Probably
wouldn't
not.
be
Probably
okay.
not. Probably right here. I mean, we can sometimes get ourselves too focused on minor things that really aren't significant in there. I mean, the bigger picture dwarfs any of that. Okay, what else? Now let's look at this. We've got 13 minutes to go. And remember, we talked about all those poor highs coming down today. Oh, and we got a poor low too. But let's just review this since we're coming into the last few minutes. Okay. C and D period match. That is not a strong high. E period exactly at half back from D period. G period half back from F period. It went up a little bit more. But just look at these matching high. So when I look at this, I'm sitting there saying, this, even though you got a poor low, but when I'm looking at that, I said the market is terribly short in here. And this is the kind of thing that you get following price. These are the kind of things that trap you in the market. You get down here and you just say, I don't want to play. There's too much uncertainty in this market. But now you've got 12 minutes to go, and you've come off the low, and you're getting a short covering rally in here. Okay, keep coming at me.
Okay. I've had a couple of some questions that are similar about the time frame. Like, how did you come to pick, the 30-minute time frame for your TPOs rather than other time frames?
I'm probably like most of you. When if you don't know the history of this, I was introduced to the market profile through Pete Stottlemyre. And Pete came into my office one day and presented this. As he walked out, he said, did I want to sponsor his first book? Because I understood the power of organizing the market under the profile. So I wrote him, he said $10,000. I wrote him a check for $10,000. Well, being the smart person that I am, I immediately, looked at 5 and 15-minute bars as well. Maybe that'll improve on it. What I found was that using the shorter bars mask some of the more important information. And I found that Pete was right initially using the 30-minute bar, and I found out that the 30-minute bar was by far the best. The shorter bars mask important information. They may mask, some of the information I've talked about today, but it's through a lot of trial and error. I did exactly what Pete suggested in the first place, but I questioned it and I tried everything else. So, I've settled on it, and every now and then I'll reevaluate it. But what I find is anything shorter than that, you start to mask some really important information. Okay.
Okay. Somebody's asking, if I know that my competition is short-term traders and they take the market too far, how is that information helpful to decide for a long or a short?
Well, again, you're coming back. Remember this whole discussion between explicit and implicit information. So you got two questions. Let's say you're short and the information says the market's too short. All the stuff I showed you down here. Okay. So first of all, it tells me that I probably want to cover my shorts because the odds, even though it might go lower, but the odds are against me. So, I mean, know when to get out of a trade, and that's one thing. Now, whether you go long, that's another thing. If you go long, you're going to keep a tight stop. You want to see the market perform. But there's no, when you start looking for exacting answers to questions like that, you're really telling yourself that you need a lot more understanding of implicit information. You need to see a lot of at-bats before the pieces start to fit together. So many times, I get people say, well, what price did you get in? What price did you get out? I very seldom have any idea what price I got in or got out at. When the odds start to work against me, I get out. And people can't believe that. They're so accustomed to price. I go market. If all of a sudden I think the odds are lining up, I go market. I have another statement, and that is that exactness kills. When you get yourself focused on exact price and levels, it can kill. That doesn't mean that I'm not aware of where a 200-day moving average is or where a trend line is. I'm aware of it, but I'm not aware of it in isolation. So again, I come back and I will stress one more time that most people will never make it trading because they simply won't spend the time. Most people will never become a good batter because they won't spend the time. Now, some people don't have the physical capabilities to be a batter. I understand that. So it's a little different. Trading, it's your head, it's your mind. You know, yeah, I was laughing at somebody the other night, and in January of 2019, I had a stroke, and the surgeon told me in the morning that, you know, my life will change considerably and I might not ever get out of bed. And I remember the first thing that went through my head. Yes, I could not move a finger or a toe on the right side of my body, but my mind was still clear. And I kept saying, well, I can trade. And then I kept thinking about what's that scientist that's so crippled, but he can, you know, he's learned how to place orders mentally. Why am I drawing a blank on his name? You know, I'm talking about. It's in the wheelchair, very, very bright guy. But anyhow, but the first image in my mind, well, I can trade. And again, but it takes the love of it, but you've got to get into it pretty deeply. And it's really where I can't stress enough. The chances of you being a successful trader without a balance between implicit and explicit knowledge is very, very slim. And that's only going to come with experience. Now, the problem is, too many times people are spending the time with experience, but they're looking at it the wrong way. They're practicing the wrong thing. And that's what's so important about getting started with something like the primer, is to start to understand what information you should be looking at. You don't have to use it the same way I do. You may have a different time frame than I do, but understand what to look at. Understand what is the significance of this poor low? What is the significance of this poor high? And then, you know, there's one poor low, but look at the number of poor highs. Well, we took this one out now, right? I mean, it takes a while to, somebody asked me, well, how, you know, you got all of these up here, so many of them. Well, how much weight did you give each one of them? I don't know. But sometimes people are trying to make a science out of it. Okay, what else?
And the person you were talking about, Stephen Hawking. A lot of people were typing in Stephen Hawking, Stephen Hawking.
Yes.
Okay. I'd like to know after, like, okay, this person is asking kind of like a series of questions all related. When you recognize that you have a bad habit, how can I change that habit? I find it very hard after recognizing these habits to develop discipline and stick to it. Having these blank mode moments for like 3 weeks of good trading. Habits like taking trades too early or taking profits too early, or after a losing trade, getting into the next trade again and not being aware of my bias at the moment. After losing money, getting into an autopilot mode and forgetting my principles, taking random trades and not being aware of how well I am doing today and react accordingly.
Okay. There's, you know, we can go on for several days to answer that. But the first thing is keep a diary. Write down your thoughts. Don't keep them in your head because we lie to ourselves. Write it down. Come face to face with yourself and who you are. That's a starting point. But if you don't know who you are, you have no idea what to work on. I have to be very careful because I have a gambling instinct. And I have to fight against that constantly. Well, you know, it's only another $400. What the hell is that? And all of a sudden it's $800 or it's $1,200. I mean, you know, it's something I've worked with all my life. But then, you know, so you've got to come face to face with who you are, what you're doing, And then you can look at our literature, but we have good books on how do you address a habit. But step one, and Jen can show you how to get to those books in there on the reading list, or you can just go to our website. But it takes work.
You go to resources at the top navigation, and the submenu will have the books link there.
But remember, it took a long time to build that habit, and it's very hard. It's very hard to do away with it overnight. I am desperately, I took a 2-week boat trip this year. I got a little extra weight I don't need, but I took a 1-week boat trip and another land trip, and I managed to gain 10 pounds. And I don't need 10 pounds. So, I'm come home trying to get it off. Well, one of my favorite things is slip out to the kitchen and Ritz crackers, peanut butter jelly, and a glass of milk. Well, so I went and I said, okay. I threw out the peanut butter, I threw out the jelly, I threw out the crackers. And I was doing pretty well. I went to the store the other day, and guess what landed in my basket? Peanut butter,
no.
jelly, crackers. I mean, I just got home and I looked at myself, what in the world? Do I have no more control than that? Well, I was kind of hungry at the time, and I said, well, I'm making progress. I can handle it now. Yeah, well, it was here probably 20 minutes before I had the lid on. So, be realistic with yourself. Face who you are. Face what you do. That's the only place you're going to start to address these habits. But
when you were at the grocery store, were you completely unawares of, what you're putting in your basket?
Remember my favorite statement. Show me a person that can't rationalize. I'll show you somebody who's really crazy. All right, what else we got?
Okay. When you look at the profiles, do you look at them only for like the last few or several days, and then the bar chart for anything that's longer term? For example, do you care about a particular day profile from weeks ago?
No, generally not. What I do, I start with my real belief is markets do trend. And so I start with the monthly bar. That monthly bar gives me a bigger trend. I then go to the weekly bar, and that gives me kind of a little view of an intermediate basis. But then what is more challenging is, I believe what makes trading extremely difficult is the markets, particularly on a short-term basis, are so random. Many times traders want to know, well, what are the odds that we'll get continuation of this tomorrow? Well, the odds are very low because of the randomness of the market. Once you accept the randomness of the market, I think it will put you in a better position. But because of that, am I aware of what has happened previously? Yes, I am. But I'm very careful to remember that how much randomness there is in the market, and you can spend too much time focusing on those past profiles. More important, what is the ability to have them parked in the back of your mind and pull them up when necessary? It's at the close. Final question.
Okay, let me see here. Somebody was asking if you could explain more about explicit and implicit information.
Okay, explicit information is things you learn exact. Implicit information is when you've taken in enough experience that you start to see beyond the obvious. Your intuition starts to work in. For example, you meet somebody for the first time. And let's say that's the first person you've ever met in the last 5 years. You may not, you may not have enough background to know, if you're comfortable or uncomfortable with that person. But let's say you've met, 100 people in the last couple of weeks. All of a sudden you meet somebody new. Well, you've stored a lot of, implicit information about people. and you don't know exactly, you can't tell exactly what it is. You know, I mean, you got kids. I have kids. Have my kids ever lied to me? Of course not. But it's funny because all of a sudden they tell me the story and you know what's going on. They're not kids anymore. They're well in their 50s. But I mean, in the days, and all of a sudden you just know there's something about the way they're saying it's not right. You want to, you know they're not giving you the facts. You base that on experience over time. That's implicit information. I mean, it's just if you're a golfer, you start off with explicit information. You hit the ball 1,000 times, you start to gather implicit information. You're in a relationship, you start with explicit information. You meet somebody, how they look, how they talk, what their education is. As you get to know them, you're gathering more implicit information. Changes the whole decision process. But it's the key. Implicit information is when your intuition, which is very, very powerful. Gary Kasparov, the chess champion, talks about it. My favorite book is Josh Waitzkin, The Art of Learning, the power of intuition. But that's another way to explore what that is and the importance of it. Let me say, Jen, thank you very much. Have a great day, and let's see what the news brings. Thanks now.
Thank you for joining us today, everybody. We'll see you to the next one. And if you got any questions on the primer, by all means, please contact us. Take care and have a great rest of your trading week.